Assalamualaikum to everyone and our dearest lecturer Puan Harida binti Haji Osman. Today we will present our mini project for Audit 2, which is about auditing procedures on equities. We hope this presentation will help to improve understanding of how equity is audited in financial statements. Before we start, let me introduce ourselves. My name is Putri binti Muhammad Zubir and my teammate is Nur Farzana Shasha binti Muhammad Rozi. Hi, my name is Putri and I will start by presenting the nature of equities. Equity represents the ownership interest of shareholders in a company. It is made up of the capital contributed by owners as well as the accumulated profits retained within the business over time. In accounting terms, equity is generally divided into several components, which include issued share capital, retained earnings, and other reserves. Share capital represents the original investment made by shareholders, while retained earnings represent profit that have been kept in the business after dividends and distributed. Equity can also be understood as the net investment of owners in the company, which reflects the financial positions of the business from an ownership perspective. For listed companies, equity is sometimes compared with market value based on share price, although in financial statement it is recorded based on historical costs and accounting standards. Overall, equity is known as residual interest because it represents the remaining value in the company after all liabilities have been settled. This means shareholders are entitled to whatever is left once the company's obligations are paid. In this slide, we are discussing audit assumptions related to equity, which are the fundamental principles used by auditors to evaluate whether the financial statements are fairly presented and free from material misstatement. These assumptions act as a framework that guides auditors in designing audit procedures. The first assumption is occurrence, which means that all transactions related to equity, such as share issuance, capital injections, and dividend payments, must have actually taken place and must be properly authorized. For example, auditors will check supporting documents such as resolutions or share issuance records to ensure the transactions are legitimate and not fictitious. The second assumption is accuracy, which focuses on whether the amounts recorded in the financial statements are correct. This includes ensuring that share capital, share premium, and dividends are calculated and recorded without errors. Auditors may perform recalculation or trace entries from supporting documents to the accounting system to confirm accuracy. The third assumption is completeness, which ensures that all equity transactions that should be recorded are included in the financial statements. This is important because missing transactions such as unrecorded share issuance or dividends can misstate the financial positions of the company. The fourth assumption is existence, which confirms that the equity balance reported actually exists at the reporting date. For example, auditors may verify share registers or confirm with share registrars to ensure that the issued share capital is real and valid. The fifth assumption is valuation, which ensures that equity items are recorded in accordance with accounting standards and are properly measured. Although equity is not remeasured like assets, auditors still ensure that transactions such as share premium and reserves are correctly classified and valued. Finally, presentation and disclosure ensures that all equity-related information is properly presented in the financial statements and adequately disclosed in the notes. This includes details such as number of shares issued, types of shares, dividend policies, and reserve movements so that users of financial statements can clearly understand the equity structure. Overall, these assumptions help auditors reduce the risk of misstatement and provide assurance that equity information is reliable and transparent. Now, let's go through to the accounting treatment of equity, which explains how different components of equity are recorded and presented in the financial statements according to accounting standards. Firstly, reserves refer to accumulated amounts that are set aside within equity, such as revaluation reserves and fair value reserves. These arise when there are changes in the value of certain assets or accounting adjustments required by standards. For example, if a company revalues its property and the value increases, the gain is not recorded in profit or loss but instead goes into a revaluation reserve within equity. Next is retained earnings, which represents the accumulated profits of the company over time. These profits are not distributed to shareholders but are kept in the business for reinvestment or future use. When dividends are declared, retained earnings will decrease because part of the profit is distributed to shareholders. Share premiums. Next, share premium occurs when a company issues shares at a price higher than their nominal or par value. The excess amount received from shareholders is not treated as profit but is recorded separately in the share premium account. This reflects that additional contribution from investors above the original share value. Share capital represents the basic ownership investment in the company. It is recorded at the nominal or par value of shares issued. This forms the foundation of the company's equity structure and does not change unless new shares are issued or existing shares are repurchased. Finally, dividends represent the distribution of profits to shareholders. From an accounting perspective, dividends are not recognized as a liability when they are merely proposed. They only become a liability when they are formally declared by the board of directors. Before that, they are only disclosed in the notes to the financial statements. This treatment is important because it ensures that liabilities are not overstated before official approval. In summary, the accounting treatment of equity ensures that all components are properly classified, measured, and recorded in accordance with accounting standards, which helps maintain accuracy and transparency in financial reporting.
Assalamualaikum and good morning. My name is Nufazana Shasha and today I would like to present about accounting system and control activity related to equities. First, for the accounting system, a company may use the equity method when it has significant influence over another entity but not full control. This means the investment is recorded initially at cost and then adjusted over time based on the performance of the investee company. Besides that, all transactions must be supported by proper documentation. This is important to ensure that every equity transaction is valid and be verified. Also, equity investment is usually presented as a single amount in the balance sheet, and ownership percentage may change when shares are bought or sold. Basically, this part is important because it shows how companies record and manage their investment properly to avoid error or manipulation. Now, let's move to the control activities. Control activities are very important to prevent misstatement and fraud in equity accounts. There are several key controls. First, any changes in share capital must be approved by the board of directors. This ensures that no unauthorized changes happen. Second, the company must maintain complete and accurate records such as share registers and share certificates. Third, all equity transactions like issuing a share or dividend must be properly authorized. Lastly, there must be segregation of duties. This means different people handle authorization, recording, and checking to reduce the risk of fraud. Overall, this control helps ensure that equity transactions are accurate, transparent, and properly monitored. Now, I will explain the audit procedures under test of control. First, the auditor will obtain a schedule of all equity account activities for the current period. Then, the auditor will check the beginning balance and agree it with the previous year's working papers. Next, the ending balance will be compared in the general ledger to ensure consistency. Finally, the auditor will examine supporting documents and authorization for all equity or transaction. This is important because auditors want to make sure that the company's external control are working properly before relying on the data. Next, we move to substantive test of transaction. Here, auditors focus on verifying the actual numbers and transaction. First, they will recalculate share capital and share premium to ensure accuracy. Then, they will agree the total number of shares outstanding with the general ledger. After that, auditor will test the accuracy of capital stocks transaction by checking them against the board of directors minutes. Lastly, they will examine the share records in the stock register. This step is important because it provides direct evidence and the transaction really happened and are recorded correctly. That's all from me. Thank you.